Welcome to our course, Understanding Corporate Financial Restructuring. Our goal today is simple: to teach you the restructuring and bankruptcy process at a level of detail sufficient to understand this incredibly complex process without putting you to sleep. So let's get started. So we're going to start over the next several slides with a simple example that provides the conceptual framework for how to think about distress. We're going to draw on material from Stephen Moyer's excellent book, Distress Debt Analysis. This should be on your bookshelf if you are in any way considering a career in financial restructuring. So let's say that I form a company and that my new company buys an investment property for $950,000. Now let's say that I finance the property as follows: a $100,000 5-year bank loan at 5%, secured with first liens on all assets. That means that if I don't pay, they've got collateral, which is the investment property that I have. Now, I also borrowed $400,000. I also borrowed $400,000 with another bank loan. Now it's a bit more expensive. It's a longer term for me to pay it back. And this one is more expensive because here the bank required only a second lien on the assets above. In other words, they're only going to be able to foreclose on the collateral after these guys are made whole. Right now, we're going to spend a lot of time in this course talking about the dynamics between the different creditors. But at the most basic level, if you have a first lien on an asset and then there's a second lien on that asset, well, the second lien can only collect on that asset when the first lien is made whole. That's why usually they'll charge a higher interest rate, all else equal. Now, the rest of the $950,000, I was able to fund with equity. And let's say for simplicity now that I paid for that with my own money, right? I actually am the only equity investor in this business. So let's draw up an initial balance sheet. This is going to be a very simple balance sheet, and let's use US GAAP. It would be essentially identical under IFRS as well, but let's just go through a US GAAP balance sheet here. Very simple balance sheet. You've got the investment property as on the asset side, and then on the liability side of the balance sheet, you've got the debt and you've got the equity. Assets equal liabilities. If you add these all up, you're going to get 950. And we feel good that everything's in balance and it's simple. Now, as a fine point, if anyone that's listening has ever started their own company, you know that you can actually, when you fund your business, you initially actually arbitrarily define a certain number of shares. You can give yourself a fairly arbitrary number of shares when you start, because what matters initially is how much you put in. You carve out how many slices you want out of that $450,000, and then you can actually back into what the implied initial day one share price is, right? So each share on day one at least is worth $5 per share, right? The $450,000 lump sum that I put into my business divided by the 90,000 shares I arbitrarily gave myself, and so each share is $5 per share. Now, I start running my business. I immediately find a tenant and I realize that I should probably have some cash on hand for everyday maintenance. I put in, therefore, another $50,000 of equity, which buys me 10,000 shares, right? I put in 50,000. If I'm still going off of the idea that each one of my shares is $5 per share, you can think of it as, okay, well, now I've just, issued another 10,000 shares for myself, and I'm good. So now I also purchased flooring from a vendor, and that created an accounts payable of $20,000. So what does that balance sheet look like now? Well, it's just a slightly more robust balance sheet, still really, really simple. It now has that $50,000 in cash. That's the debit from that, from that transaction. The corresponding credit is the $50,000 in that hits the credit's common stock, right? So now my balance sheet's still in balance. This went up by 50 and this went up by 50, right? Remember, this was 450 before. So we went from 450 to 50, and this was 0 because I used all my money right away to buy that operating asset, that investment property. Now, the other thing that I mentioned is I've got that payable of 20,000. So this credits the liability side, and the corresponding debit is the now flooring that is capitalized here as an asset. And so now I've got total assets of 1,020, and I've got total liabilities and equity equaling 1,020 as well. Now, remember, at $5 a share, this is why I get to 10,000, right? The extra $50,000 just means kind of nominally I have to issue myself 10,000 shares, bringing me to 100,000 shares. So I've got a total now of 100,000 shares in this business. So now some time has passed and business is good. Rental income is flowing and my balance sheet now looks like this, right? I've got 90,000 in cash. All of a sudden I've been operating this business and I've been able to increase my cash balance a little bit. And notice that what's happened is because I was able to do that because I generated profits, right? You have this new line, retained earnings. I was able to generate profits, and that's given me that additional $40,000 in cash. That was the debit, and then the credit here, the offsetting entry is retained earnings. Everything is in balance, and I'm good to go. Now, I decide to get ambitious, and I want to do a large renovation on my investment property, and I estimate that I'm going to need another $150,000. Okay. Instead of taking on more debt or putting in my own capital, I decide to issue equity to other investors. I decide to go out there and raise some equity capital. So now, how many shares should I issue? Recall that initially I valued each one of my 100,000 shares at $5. So suppose I retain an investment bank and they advise that assuming I successfully do this renovation, my business actually has an equity value of $900,000 because the value of my property will increase due to higher rents. Now, you may recall that investment bankers, when they do a valuation, those of you who have done some valuation work before, investment bankers, when they're doing this work, they're not really looking at the balance sheet value to figure out what the value is of your company. They're doing a discounted cash flow analysis. They're trying to figure out what other people would be willing to pay for it. And so they've decided $900,000 is the value of the property. If you really think about it from an academic perspective, it must imply, you would hope, there must be some connection to intrinsic value, which means, well, maybe because the value of my property is now going to be higher because I'll be able to collect more rent, right? So this becomes sort of based on a forward-looking analysis of what the equity value of the business is. So based on this analysis, try to calculate yourself how many new shares need to be issued and what is the implied share price. So give that a minute, and when you're ready, move on and watch me calculate it.